Amit Burman's connection with the food business is more than a decade old. The vice chairman of Dabur India Ltd moved out of the executive role at the mothership when Dabur Foods was merged with the parent firm in 2007 and went on to start Lite Bite Foods Private Limited. The new private venture he started has already built a string of fine and casual dining restaurant chains, besides being one of the franchisees in India for global QSR chain Subway, with total revenues topping rupees 100 crores. Recently, Burman even acquired a fine dining Italian restaurant in London, which will be his private venture separate from Lite Bite. In a candid interaction with VCCircle, he talks about his love for food as a business, why he prefers putting his own money or debt rather than bring in PE investors in Lite Bite, the food business of Dabur India, and much more. So, Mr. Burman, take us through your relation with the food business. How has it helped you over the years, and what are your plans for the future in terms of private ventures in food, in terms of Lite Bite, and in terms of your connection with Dabur for the foods division?
So my interest in food has been since I got into working with Dabur India Ltd. When I joined the company, we didn't have a food vertical as such. When I joined, I started researching in the food area, and what intrigued me was juices in the packaged form. At that time, in 93, 94, no packaged juices were in India. As such, there were only tins with juices in there which had a lot of preservatives in it. And as coming out of the US, studying there, and then in the UK, I was used to having a glass of orange juice every day in the morning. It was like a habit as such. And in India, you couldn't get that only if it was a fresh available, then you would have it. Otherwise, the tin was not very appetizing. So I clearly saw the gap in the market and started developing our brand called Real. Started with mango, pineapple, orange, which now have become almost commodities, and then went into a lot of exotic flavors and launched Active. And I ran the business for 10 years, grew it to almost 8-9% of Dabur as such. Today, the foods division, as I started it, is almost 12 to 13% of Dabur, and close to almost 700 crores worth of sale. When I merged it into Dabur India Ltd and then moved out to do my own business as such, that's the time it was about 9%. And then continuing my love for food, I decided let me go on the other side and see how it's done there. That time retail was becoming let's say the buzzword. People are looking into retail in different ways, kinds of ways. I looked at it more of an F&B organized play. Started researching and developing brands. So Punjab Grill, Asia 7, Fresco, and Zambar now are our brands which we've grown in the CDR market, casual dining market. In the quick service, we have Street Foods of India, Pino's. We have franchises of Subway, and we have our own Baker Street, which is there at the bakery cafe. So these are the brands which we started with and started expanding into India as the retail spaces started coming through. So that's how my let's say food fantasy has gone over the last 15 years as such.
Recently, you have also acquired a London-based Italian restaurant chain.
That's correct. The restaurant we've acquired in Londyn Scalini it's about a 25-year-old restaurant, very, very successful, doing very well in London. This is something which I've done outside Lite Bite. The reason being that internally in Lite Bite we are more focused on casual dining, quick service, and the more multiplicity of these brands. Scalini that way is a very high-end brand, and it cannot probably multiply inside the UK itself, but definitely the thought there is that if we can put that winning formula in different geographies where the clientele who are coming from eat in Scalini in London, be it I think the number one clientele there is the UAE clientele, number two would be the Indians. number 3 would be Russians, number 4 would be the Americans. That's how I see it. So even putting 1 or 2 of these outlets in these countries, is something which we want to do going forward. In terms of Lite Bite Foods, it's more to grow the restaurant within India and franchise them out. We have done that in the past. Punjab will today we have a franchisee in Singapore, we have a franchise location in Bangalore, and now we're actually going to be opening one in Bangkok very soon.
Yes.
And then after that Abu Dhabi also quite soon. So that's where we are at.
So even when you get Scalini to India, so that will be under a separate division.
Definitely, I think I don't think Lite Bite will look for a franchise of Scalini. It'll be through a different company where anybody who is an operator in Bombay or Delhi and a high-end operator, we would like to go with them to go and do Scalini in India.
So are you still open to acquiring more of such ventures outside Lite Bite, and if yes, what are the areas that interest you?
Well, I think this was more of an opportunistic one, also a little bit more emotional one, because we have all been to Scalini, and if you ask anybody around Delhi, who go to London very often, everybody's gone and eaten there. So I think it is an iconic brand, which I feel is iconic for Indians and for people in the UAE. So it made sense for us. But yes, if there are opportunities out there to take the learnings which we've done in India outside, I would love to have a look at it and see how we can acquire those.
Okay, and you're open, and that would again be separate from.
That's correct. At some point, if they all meet up, it may happen also.
Do you have any budget for such acquisitions?
See, these acquisitions usually come, on your desk through an iBanker or things like that. So there's never a budget. But then, if there's something which we like and I like and is iconic, would definitely take out the money to go ahead and do that.
This one seems like a expensive acquisition. You said around 5 million pounds is the annual revenue.
Yeah, that's the revenues they generate.
The top
and
line.
good EBITDAs also. But then in UK and other parts of the world, the prices or the EBITDA times the what you pay is not as much higher as what you do in India.
Yes. India also, you would be open to acquiring companies.
See, in India, as I see it, if you look at the space of casual dining, in India, 80%, or be it quick service also, 80% is actually of the middle class, upper middle class, who eat out in malls and so on. They eat Indian, Chinese and Italian and South Indian, to that matter. And then we have 4 brands in those areas. So Chinese, we have a Pan-Asian, so it connects a lot of Thai and Korean and Mongolian and Burmese. Mediterranean cuts through most 90% Italian and then a lot of Spanish and so on. Indian, North Indian, we have Punjabi, South Indian, Zambar, again in that space. So I think we are catering to almost 80-85% of what Indians eat outside.
According to the demand.
Outside. In the quick service, if you look at it, Indian eats again pizza, Chinese, South Indian, North Indian, and a little bit now because of McDonald's and KFC's, the burgers and so on. So again, we have brands in all the different areas. So an acquisition, I would imagine, what would an acquisition be? Because I think we are probably in all the different areas, and rather than acquiring something new, I would probably put money into expanding these into a much bigger operation as such. And again, if it's an acquisition of iconic brand or a master franchise of an iconic brand, yeah, definitely I would be happy to look at it. So I would say iconic would be something like a McDonald's or a Starbucks. So if there was an opportunity,
you mean foreign brands that want to enter India would
as a
attract?
Master franchise, exactly.
Okay.
So for attract as a master franchisee, because those are something which we don't need to sell as such, but Indians going outside already are aware of the brand, and you see people lining up in Starbucks to go for a cup of coffee, and that's the reason, because they are brand. Now, if it's a small brand coming out of Canada or US, it doesn't make sense for us because nobody knows it here. We have to build the whole thing here, so we put in the money. I might as well put in money in my brand. Why would I do it in another brand?
As an entrepreneur, how difficult is it when you have your homegrown brands and you also have Subway? So when you think of expansion, how do you divide it?
So our focus is going to be definitely on our own brands as such, totally. And for us, what happens is that when we, the way I see the other brands which we have in our portfolio, which are franchise, I believe if the developer wants us to do it, then we have that battery to do it. Like if you look at Ambient Mall, Gurgaon, we have the whole food court. Now a Subway would work there, a Pollo Compero would work there, and therefore we do it. But if I was to go and take a standalone location, I would go and do my own brand as such. Similarly, if you look at the airport, again, there are some international brands which the developer wants, and there are some our brands. So that's the time I would do it. But I wouldn't. I don't have a master franchise for Subway, and there is no master franchise as such. So I guess the person who's a developing agent has to worry about the expansion of Subway in India. I don't have to worry about that. Mine is more opportunistic as such, and depending on the location.
So this is something that would fit into your portfolio, this kind of...
So for me, Subway would be a locational thing. For me, my own brand would be more of a strategic thing.
You've also mentioned of achieving 500 crores in the next 3 years and going public. But correct me if I'm wrong, your revenues at present are around 100 to 150 crores.
Yeah.
So is that a very aspirational target that you have to reach 500 crores? And what is your route towards going to public?
So we are getting, one way of growing is of course what we are doing today in terms of different location, different food courts. Second is that we've just started franchising out, and I think over 3 years, most of our brands should be franchised out and with multiple locations as such. Thirdly, which is the bigger one, is the travel retail food. If you look at the travel retail food today, after winning the Mumbai airport, which is about 30 locations, which we have to do in the next 1.5 years, we will be the largest in travel retail. I think with that 30 restaurants, which will be all stable by next year, I think that will only double our turnover straight away. If we were to do it correctly. Then we're also bidding for the Chennai airport and the Kolkata airport, and then after that, the next airports will come up is Ahmedabad, Goa, and all those airports. Those are big opportunities for us, and seeing our capability in the past and seeing what we have now to do in the future, these airports looks like something which we would be able to do and be able to get it. So that is a big chunk of where our turnovers will come from. Franchising, travel retail, and the normal cost of growth, I think so.
And also, what about the IPO route?
So I think that is a little bit far away, maybe 3 years, 4 years, I don't know yet. I think we'll only be able to tell depending how we execute and we go forward in the next year or so, that where will we be.
I'm sure a lot of PE investors also approach you with interest in Lite Bite. So what is your take on that? Have you ever thought of involving a private equity investor in the growth path?
See, right now we have engaged with a couple of PE, but our thought processes have changed that we may not want to go with a PE as of now. Reason being that we are in a fast growth space right now. We are just implementing ERP in our company, so we will actually are partnering with SAP, and we should be live by April 1st this year. So that will take us 2-3 months to stabilize, and I know when a PE company comes, what do they want in terms of process. So I'm actually doing that process today in terms of SAP, in terms of which are the outlets which have this EBITDA, X EBITDA, Y EBITDA, and what should it be, and what should be closed, what should be open. So all that thing we are doing. So let's say we have a clean up kind of thing happening. Of course, the growth is happening on the other side also. Plus, I think till we are available, we can put in our own money or money as debt. Is probably a cheaper way of growing than having a PE, because if you look at a PE, the what returns they want is about close to 25 to 30%, of what they put in, which is more expensive than getting a loan at 12% from the bank. Now, if you really want somebody to do value add, then I would look at a PE which not only gives me money but gets me some insights of of the restaurant business or a quick service or casual dining, or has some inroads for me to grow. Maybe have some connections in the US.
A sector-focused fund.
Yeah, I don't want only the money, because we don't only want that, because I think we through our abilities can raise money in terms of debt, in terms of our own cash flows. So if there's a PE which can add value to what I'm doing, yes.
Open to the idea of having a PE.
Yeah, we are open, but as I said, that one is he has to have the knowledge of the sector. Second, of course, the money and how openness they have in the terms of long term. Those two things matter, because for me, my money or our money here also wants to grow at 30%, or our ROI should be also 30%, and that's how the PE looks at it also. So if I can fund it cheaper, I would probably do that. So it's a trade-off, I would say.
Okay.
See, by God's grace, we don't have let's say a problem about money. There's a lot of entrepreneurs who have to go to PE for the next stage of growth.
Yes.
We have a choice, by God's grace now, so we can decide. It's not that we have to do it.
But you have people approaching you.
Yeah, so as I'm saying, so it all depends on who, which, why, so on.
Okay.
Yeah.
So how much money will you be investing in Lite Bite this year?
In the next 3 years, with the travel retail, almost another, I think, 50-60 crores will go into the business as such.
Okay. And you're expecting an ROI of 30%?
Aiming. Any entrepreneur would like that.
This is a business with tight margins?
Well, it all depends. A QSR, if you are getting a store-by-store margin of about 15 to 18%, it's good, because it's more numbers in a QSR. In casual dining, it's much higher, but the outlets will be lesser. So in casual dining, Punjab will have, some of them have 30-32% as EBITDA margin, but anything above 25 you should be good in doing. So those are kind of margins we work at, or we look at when we are opening a new store or current store where we are.
They have increased over the years, the margins?
Well, yes, it has increased. In the casual dining, definitely. In the quick service, they haven't increased much, because the price we can charge per customer is it's very difficult to increase that, and the taxes and all are only going up, and all the input costs
gone up more this time.
Yeah, and the input costs are also going up, be it electricity, be it fuel, be it all that kind of stuff.
So, but if you would be raising money, what amount would it be?
Yeah, I think any PE who comes in will commit to a certain amount, but I think they have to see our growth path and what is required as such. So, meaning, it all has to depend on their vision versus our vision. If they are matching, and if they do, then it all happens in phases. So I can't say now, if the PE likes my growth story, they'll keep on putting money in phases, depending on how it is. So putting a specific number to it is a difficult job now, because we have not discussed those numbers with anybody. So
okay, it's all in the very initial stages. But going public is definitely at the...
Well, at the end of the day, of course, that's the goal to happen.
Now, talking a bit about Dabur.
Sure.
2007 was the time when the food business was merged with the parent company, and, as we read, the aim was to have larger acquisitions. And we have seen that after that, even when the company has acquired, it has only been in the skincare space or FMCG companies, and not really food companies. So why do we see this with Dabur's strategy?
So foods, if you look at it, we are the largest in the fruit juice business as such today. And that's where our focus is. Our focus is more beverages, fruit beverages, and that space. I don't think there are many acquisition targets in that space because we are the one who started it. So they're very smaller kind of things, and whichever way you see it, we are penetrated in almost every market. So just a brand, why would I buy a brand for a flavor? I can put a flavor, the same flavor in my own real or my own active as such. So therefore you probably haven't seen more acquisition in that space.
Okay, so there are no targets.
There are no targets. I think we have grown again in terms of acquisitions. We've done an acquisition in Turkey.
Yes,
which was a
first overseas.
one.
Yes.
And then we did another acquisition in the US, which was again in the hair space. US is about 2 years now.
Okay.
So it's the hair straightening space for Black Americans, and I think the idea behind it, of course, to grow the brand there, and there's a lot of opportunity there. But also the bigger idea is to transport that into Africa, where we have a very strong presence. So then those products are used in Africa, and this brand would do very well there.
Okay, so your last acquisition was 2 years back.
That's correct.
So why the certain aggression? Are you taking time to digest acquisitions?
Well, it always takes time to integrate. But having said that, that's not stopped us from doing an acquisition which makes sense for us. So I think a lot of things come to our plate, but again we have to sift it out very carefully of where we want to go, where we don't want to go, what is the right team, what is something which we can digest, and things like that.
Okay. And also, coming again to the food business, where you were very closely involved and still are very closely involved with Dabur. You said it was 9% around 2007, and now it's 12 to 13%. So are we going to expect a very similar growth in the food segment in the coming future, and what will drive it?
See, if you look at the sector, when I was running it, I was also growing a year on year at 50%. Because it was a smaller start. Now the food business is growing at 27-28% as such. So it's still higher than what the parent company, which is growing at 19-20%. Over time, this gap will probably come down, where of course we have to keep on entering in different segments, and that's what we are doing to grow as such. And if you look at the number of flavors, we are much ahead of any of the competition. So going forward, hopefully we will get the similar kind of growth over the next 2 to 3 years, and I think the way Dabur is growing and the way the international business is growing for us, I think we will be at about 12-13% in the next 3 to 4 years. International business is almost 1,000 crores of business now for us with the acquisition of Namaste. You see, so that has grown. So therefore, both foods and international are growing at the same pace. So actually, I think
so we will see a uniformity.
Yeah, you'll have 15% growth in 15% international taking apart 12 to 13% food, and then the consumer care and healthcare, which is the other part.
Is food a lesser margin business than the other businesses in Dabur?
Well, there are so many different businesses in Dabur, so it's very difficult
FMCG and food?
Yeah, food is a little bit lower, but not that much. The reason being that, like if you look at, suppose, example of an orange juice. Now, a housewife, if you're selling an orange juice for 85 rupees, a housewife can calculate how many oranges go into it, and then they don't put value onto packaging and don't put value into processing. So they say, okay, we can only pay this. But if you do an exotic blend, if you do fiber with green apple or fiber with strawberry and banana. Now that is difficult for a consumer to understand how to make that or what is the blend. So your commodity juices, the margins are lower because then everybody's competing with your Pepsis and Cokes of the world. But your exotic variants like Active, which we have done and taken into a different level, adding the fiber or vitamins or whatever, those you can charge higher premium on it, and those margins are better. If you look at the FMCG business now, if I was to sell you a toothpaste, you would have no idea how to make it, and you would have no idea what it should cost.
Yes.
Now I can charge a Sibaka or a Babul at 10 rupees for 50 grams, and I can charge for a Sensodyne at 200 rupees. And there's a buyer for Sensodyne, and there's a buyer for this product too, or our Dabur Red for that matter. At 150 bucks. Now the margins over there are much more different because you cannot calculate how much goes into what. It's all a question of marketing. Of how you, and then the marketing spends over there are also high because you're really fighting for this huge market, but it's controlled by big multinationals as such.
Okay.
So that's the kind of difference.
So in food again, we can't expect any acquisitions in the coming future.
I don't see any targets. So
unfortunately.
I don't see any targets.
Okay, but outside also, is it that the pace has gone a little, like outside food also, will we see a slower pace as compared to?
You see, again, it's opportunistic, I would say. So if there is an opportunity coming up in the food arena or a brand or in FMCG.
But what would you like in food? Like you're saying that there are no opportunities. If there were, what would it be?
See, I'll tell you, in foods, we will probably not acquire anything as of
organic
now.
Growth?
Yeah, I think it'll be more organic. So tomorrow, if we see, suppose in Africa, there's, the juice market is growing and it's, it doesn't have too many players in there or too many multinationals in there. It would make sense for us to go put a plant there to.
Are you outside India in the food business?
No, we're not.
Not.
The reason being that a lot of our concentrates and pulps which we get are imported. So, like our orange concentrate comes from Brazil, Europe. Apple concentrates come from Europe, from Germany. So it doesn't make sense for us to import it here and send it back into Europe. It doesn't make logistic sense.
Yes.
So if we were to have a plant in Europe or in Africa which can feed, then it would make sense. So that's something which we can look at. But acquiring a brand right now in foods, wouldn't make sense.
Is it on the cards going overseas for the foods? So
see, we are already putting up a plant in Sri Lanka, as you may be aware, but that's more also to do with, of course, Sri Lanka, but India-centric.
Okay.
But we have to evaluate places like Dubai or Africa to put up a plant there. So in any fruit juice plant, it's a big investment as such to come up with a couple of lines. So it's let's say a big gulp to start thinking, okay, now we can do foods. And foods also, what happens is that you need to spend a lot of money in marketing also, because depending on what the local brand is doing and what it is there. So we have to really be sure.
Are you looking at more of private ventures apart from what you're already involved in, and what would interest you as an entrepreneur?
So I think I have right now enough on my plate.
Okay.
So let me take this to the next level, and then I'll see what I need to do.
Have you ever thought of also having a fund, a VC fund for investing into different companies? Does that come to your mind?
Yeah, probably. I think that would be my next stage thing, because actually speaking, I had run the food business in Dabur for 10 years, and I've been here now for 5 years. So maybe my thing is, I guess every 10 years I change what I'm doing. So maybe in the next 5 years you may see me with a fund and investing into.
Even I see you.
Let's see.